Hello and welcome to the Monday Futures Market Outlook for May 14th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we've been bullish the U.S. dollar primarily based on our forecast of a weaker euro. We have now, in the last week, have exceeded the April highs and are very close to testing that 81 level, which was the March highs of the consolidation. We're probably going to very soon see a resolution to this 4 or 5 month sideways trade range that we've seen in the U.S. dollar, but likely we are going to first test some overhead resistance levels in the next little while. So while we probably could see even a full 1 point move on the upside of the US dollar, we will be looking for that price action to stall and consolidate before we take a much bigger picture bullish stance on the US dollar. The bullish stance on the U.S. dollar very much comes from looking at the euro and looking at how it's broken down, with the euro now having broken that 130 level on the downside and having followed through. The next major support doesn't come in until the January 2012 low, but using our technical measurements, there is actually nothing preventing the euro from even reaching levels as low as 120 later this year, while we're not initially looking for that in the, let's say, the month of May. This initial wave of selling and this breakdown we're seeing right here may very well be the first leg or the first signs of that selling follow through. So let's watch where the initial supports come in. It probably may still even see another couple hundred pips lower on that euro before we get a bounce, and then we'll be looking to set up a much bigger picture outlook on the euro from there. Next year, I want to take a look at the 30-year Treasury bonds, and once again, they have now very bullishly broken up. We have now definitely exceeded many of the highs that were put in December, January, February, and in fact are looking for almost a direct retest of all the way back into the September, October highs that occurred up along the 147 level. We remain relatively bullish bonds in the bigger picture. We simply are reluctant to switch short-term bullish on just in case it's interpreted as a buying opportunity right now at this stage in the bigger picture. Even if we do break to a higher high, we're going to need some sort of a consolidation point to reset the risk-reward proposition of short-term long positions in Treasury bonds. But if we see a risk off of a trade coming off of Euro bonds and coming into the treasuries as an alternative, we definitely have room here for a substantial rally in the second half of the year, and we remain optimistic on the upside. Next year, I want to take a look at copper futures, and copper now is trading decisively below that 360 level. Let's see if we have a closing day down at this level or whether this reverses by the end of the day. Nonetheless, we do believe copper has room to drop here, especially after that failed rally attempt, and it would not surprise me if we saw 330 or 320 on the downside of copper in the upcoming month. At this point, we are decisively bearish commodities. Next year, I want to take a look at the crude oil contract, and really at this stage, crude oil is decisively bearish. But in being decisively bearish, we are at the same time approaching an important support line around this 93 to 95 zone. It would not surprise me if crude oil bounced off of this level, and even if we had even a $3, $4, $5 bounce at some point. But that will more than likely just be another shorting opportunity. We do believe there is room for crude oil to continue to deteriorate on the downside, and we will be looking to see whether that does materialize. But again, it doesn't mean on the short term we won't see a bounce here somewhere. Next year, I want to take a look at gold futures, and gold is now broken down that level off that 1630 level that we were talking about, and has now worked its way down to the lows that it has put in back in September and December of last year. This is a crucial support line where gold will initially have to find its lows. We may even see a very temporary drop down to the 1520 level before we get that bounce, but we are looking for a bounce in here. If gold, for whatever reason, ripped through this lower support line, and let's say went down to 1500 level and started consolidating down there, it would be actually much bigger picture bearish, and we would at that point be even considering the idea that gold's going down to 1400 or lower throughout the remainder of the year. So this is why this level is so important, because it is very crucial for the gold bulls to hold this line, and they'll need this line to hold in order for that bigger outlook to materialize. So when we take a look at the S&P 500 chart on the weeklies, we put an 80-week moving average on there to depict the bull and bear market cycles the market has gone through over the last 30 years. Last year we went through a couple of false start signals up and down as it chopped over that, but the moving average is distinctly pointing higher, indicating a bullish trend to the market. At this stage, while there's a lot of people out there that could paint a much more bearish scenario, at this stage we initially are of the opinion that this market correction will be exactly that, and retest that moving average on the downside and may reverse right back to the highs again. It would take a substantial drop below the 1280 level in order for us to really start considering a more bearish scenario. So let's see how that develops in the upcoming weeks. When we take a look at the S&P 500 chart on the daily charts, you can see the double top that put in the break of the neckline. At this stage, the S&P 500 is in sell mode, and if we see any acceleration from this level on the downside, we could first find support right around this 1330 level, right in the middle of the focal point. But really, if the selling does accelerate, we could see a very rapid test of the 1275 to 1290 level, where that 80-week moving average lies. That would probably create a short-term support that would allow the market to have a rally back at some point into the month of June and July. But we probably will first see selling down to these levels before a short-term bounce. In the much bigger picture, this is going to be a lot of crucial information that we're going to gain at these moments, because if for whatever reason this market correction turned into a crash, and we don't necessarily want to forecast that, but we certainly will not deny the possibility that could occur. If the selling really here accelerated on the downside into almost like a crash-like movement on the downside, that may very well change the outlook of the whole market in the bigger picture, and it would certainly at that moment have us to reconsider how the market will play out into the second half of the year. Nonetheless, let's just watch whether these support lines hold the initial waves of selling, and whether or not that will materialize a market bounce. To look at our key intermarket observations, we still have yet to switch our short-term outlook on the U.S. dollar to bullish. At this point, we're more than likely going to wait till the euro tests a key bottom and then bounces, and then same with the U.S. dollar reaches the top end of support and corrects a little bit. And depending on how that correction plays out, then it would change our bullish outlook on the short term for that immediate move. We don't want to change now on the risk that people will interpret that as a buying opportunity immediately. At this stage, we think that we need to first see where these levels establish themselves for us to become short-term bullish on that. We are bearish commodities right here, short-term and long-term, and long-term being the remainder of the year, and not like a multi-year trend. In the same regard, bonds, we feel at this stage, if we haven't switched to short-term bullish several weeks ago, again, we're reluctant to do so until we have some sort of a consolidation point. But we do want to switch to being short-term bullish bonds. We're just going to need technical consolidation in order to do so. In the same regard, we don't want to be long-term bearish stocks until we have some sort of evidence that a bigger picture trend reversal has occurred. And so while right now there's nothing stopping this from just being a correction that will be bought, we're going to remain long-term neutral, but obviously on the short term we are bearish, looking for that S&P to test still some lower support lines on the downside. That was your Monday Futures Market Outlook. Thank you for joining me.